Welcome to the Empowering Agriculture Through Tribal Sovereignty series. In this resource, we will be discussing credit access and financing your operation as tailored for young producers and beginning farmers and ranchers. So before we get too far into this topic, it's important to establish a baseline of what credit is. And credit is essentially a contract in which you as a borrower receive something of value now, usually money, agreeing to repay the lender, the person who gave you that thing of value, at some date in the future, generally with interest. And interest is simply the cost of borrowing. And you think about this in terms of your car loans, your student loans, home loans, credit cards, farm loans, and even store credit. The principal of the loan that you get the credit for is going to be the actual amount that you borrowed. The interest is the cost of borrowing, and that's the rate that they're charging you to take that money out. So those are some examples of credit in practice today. And today we'll be discussing credit scores, credit bureaus, and credit history and credit reports, and how these things might affect your borrowing ability as you seek to finance your personal goals or your agricultural operation. So credit scores. What is a credit score and where does it come from? Well, essentially, this is a number that is assigned to your credit worthiness. And it really depends on what that score is because there are at least 6 different credit score scales and they all have different ranges. Most lenders look at the FICO, which is kind of the industry standard for personal credit. And the list below has a good representation of scoring based on a FICO score, although these numbers will kind of differ depending on what each firm that you're looking to borrow from uses. This is typically a good representation of industry standard. Now, FICO is simply a trade name. It stands for Fair Isaac and Company. And every credit reporting agency uses a different mathematical formula to calculate your score. Now, as we know from our studies before, in algebra and mathematical equations differ according to what you put into them. And this is simply saying that each credit entity and credit reporting agency does this a little bit differently, but ultimately it's going to come down to what your FICO score is. And this is a function of several different things, and it depends on the age of your accounts, how long you've had them, how many times you've paid on time, how many times you've been late, total available credit line. Are you using a lot of that? Not a lot of that. They're all usually a few points different, but again, everything seems to gravitate towards the FICO score in the industry. Now, when you're looking at a first-time borrower, lenders are typically concerned with your past credit record because they want to make sure that you are not a risky prospect to lend money to. And this means that we have to talk about your credit report, which is where you can see your credit history. Remember, your credit report is not the same thing as your credit score. A credit report is a detailed report of your credit history. Think about this kind of like your academic transcript when you're in school. It has a whole history of all your grades and what you made of every class, but it doesn't necessarily have a number that kind of is an average or a summation of all of that. That would be like your GPA. So think about your GPA and your credit score as one and the same, and a credit report kind of like the transcript that kind of gives the details of what goes into that number. So credit bureaus collect this information and create credit reports based on that information, and lenders use the reports along with other details to determine loan applicants' credit worthiness. And there are 3 major credit bureaus in the United States that are often used: Experian, Equifax, and TransUnion. So each of these has a different history, and different entities from which you've borrowed from may report to one bureau, a couple of them, or all 3 of them. But in order to access copies of your credit report, go to annualcreditreport.com. Federal law in the United States allows everyone to get at least one free credit report per year. Usually it's one, unless you're going through some other service that for some reason is able to still monitor that, but typically it's just one under federal law, what the law allows. The website makes the process pretty quick. Your credit score is not affected by getting your free report each year. If you don't have reliable credit access or internet access, you can still request your free reports through the mail. Call Annual Credit Report toll free at 877-322-8228 for questions on this process. Be sure to request your credit report from all 3 major credit agencies. because, as I said, not all credit accounts report to all three bureaus or any bureaus. So your reports can look different depending on what has been reported. This is especially important if there is an error on one of your reports, but not on all three. The only way to know is to get all of them. And again, according to which report you pull, here are some examples, just some screenshots of different credit reports. They're going to appear differently according to each firm that you look at. But in some, they all have the same thing. The credit limits on your accounts, how long you've borrowed from them, if you've ever been delinquent, and how long the account's been active. Uh, different entities that might have looked at your credit. If you have hard inquiries, which show up on your credit report and affect your credit score, it may show you as being more of a risky prospect to lend to. But if you are a person that doesn't have a lot of hard inquiries and you have good payment history, and your accounts have a lot of credit left on them, that might factor more favorably into giving you a better credit score and making you a better lending prospect. So again, like I said, with your credit report, there are a section of inquiries. They come in two flavors that impact your credit score: a hard inquiry and those that don't, a soft inquiry. A hard inquiry isn't necessarily bad, but it will appear when you apply for credit. Always read these to make sure you recognize the institution listed as making an inquiry. Mistakes and identity theft do happen. So when you're looking here, the inquiries that may impact your credit rating, if you see something like, for the example here of 123 Utility, and you never had an account through them, that might have mean that someone tried to establish or did establish an account in your name through 123 Utility. So it's important to monitor those hard credit inquiries as well as the soft inquiries, even though they don't affect your score. That might show you that your account is being used in a way that you wouldn't approve of. So to summarize the credit basics, your credit score is a number that some lenders will use to decide whether or not to extend credit to you. Your credit history comes from your credit report. 3 credit bureaus, Experian, Equifax, and TransUnion, are the major companies who keep credit reports. You can get one report for free annually from each of these companies by visiting annualcreditreport.com. Different lenders report differently, so your credit reports may look different from each bureau. Read carefully and dispute any wrong information. If there are negative entries due to factors outside of your control, make a note and explain the situation to that entity so that a creditor will see that in the future. So now we're going to switch gears and talk about financing agricultural operations. Now, there are many different options that exist to finance your operation. Traditional options would include banks and lending institutions, the farm credit system, insurance companies, private financing, native CDFIs, and public options, which include the USDA Farm Service Agency. Our focus in today's topic will talk about the USDA Farm Service Agency, but we will briefly mention and cover an overview of the farm credit system and native CDFI financing options. The USDA Farm Service Agency is an agency housed within the U.S. Department of Agriculture, and it is a federal agency tasked with providing direct lending and government-backed loans to agricultural producers. The approval is less concerned with credit score and more focused on overall credit history. So again, with the credit score not being as applicable, your FICO score won't matter if you go with this route, but they're going to look more so at the payment of your account and see if you've had any delinquent debt, particularly with the federal government. And we'll get into that in a minute. But just know that your overall credit history is what they're going to look at. They will not automatically disqualify you from getting a loan because you've had a previous history of slow payments, no credit history, meaning you've never borrowed before, and you've had recent poor credit when problems were temporarily due to conditions outside of your control. An example here relevant to the context of today would be, an adverse situation that may have been a result of the COVID-19 pandemic. They want to see an acceptable credit history from the applicant. So here's the thing. This includes your credit history at the federal government. Previous loan repayments do matter here. So again, this is more of a holistic approach where they're concerned with your overall credit history. They're concerned with you being able to pay those accounts, not necessarily being slow with paying them, but they're more so concerned of the whole borrower approach here. And you're not really held to a number like you would be with a private entity. The USDA Farm Service Agency is a lender of last resort, meaning that they can offer lending options when commercial lenders won't, but on a temporary basis. And their goal is to assist farmers and ranchers with lending until they are financially prepared to transition into the commercial credit system. When borrowers graduate to commercial credit, their FSA loans are refinanced with a commercial lender. So essentially, what this means is that you would start out with Farm Service Agency, but later on, you would be refinanced with a private entity such as a bank or one of those options that we talked about a few slides back. And here is a list of FSA farm loan programs. And this is some things that you might want to think about in terms of which ones you're applying to and which ones you would like to research further that may be applicable to your operation. We will go into the dollar amounts that you can go up to with these, what you can pay for with them. And again, some things to think about in terms of whether or not they might apply to your operation. This matrix was pulled together by our great partners at the Intertribal Agriculture Council. We greatly appreciate their assistance in compiling this as part of their technical assistance network. So that has been a great resource for us, and we do a lot of work with them. So I did want to give credit for this in the subsequent slides that do break this down. So the first loan that we'll talk about is the micro loan, and this goes all the way up to $50,000. And these are operating loans designed to meet the needs of small and beginning farmers, non-traditional, specialty crop and niche type operations by easing some of the requirements and offering less paperwork. So it's a smaller amount of money, but it's more streamlined for smaller operations. Direct operating loans, those cap out at $400,000, and they are used to purchase items such as livestock and feed, farm equipment, general farm expenses, and family living expenses, and making minor improvements or repairs to buildings and fencing. So this is more of your day-to-day cost of upkeep and running the business. But if you're looking for acquiring more capital in terms of ownership of assets, you would look more at the farm ownership loans. The direct farm ownership loans are used to purchase, enlarge a farm or ranch, construct a new or improve an existing farm or ranch building, and for soil and water conservation and protection purposes. Now, there are some programs that cater to targeted loan audiences. The youth loans go up to $5,000 and are used by young people participating in 4-H clubs, FFA, or similar organizations to finance educational, income-producing, agricultural-related projects. And if you're familiar with any of these organizations, essentially what this would be is, your livestock show animals, maybe a small cow-calf herd. Those are very common with these. Minorities and women is another target audience demographic. Minority and women farmer and rancher loans support with full participation of minority and women family farmers in FSA's farm loan programs by targeting a portion of its direct and guaranteed farm ownership and operating loan funds for minority and women farmers to buy and operate a farm or ranch. So there are some kind of different audience programs that might be targeted by these, and that would include tribal producers as well. And again, beginning farmers and ranchers loans provide credit opportunities to eligible family farm and ranch operators and owners who have been in business less than 10 years. So again, if you fall into one of these target audiences here, which many of you probably do, with this being catered toward youth producers, beginning farmers and ranchers, and there's going to be some overlap with tribal producers. These are some programs to really research going forward and looking through our other modules and materials through the EATS Academy that we've developed surrounding these programs. Now, there are some specialty loans that the FSA does have. Guaranteed loans enables lenders to extend credit to family farm operators and owners who do not qualify for standard commercial loans. Producers receive credit at reasonable terms to finance their current operations or to expand their businesses. Financial institutions receive additional loan business and servicing fees, as well as other benefits of the program, such as protection from loss. Now, emergency loans help farmers and ranchers recover from production and physical losses due to drought, flooding, or other natural disasters or quarantine. And so these things are ultimately things to look at. Now, to kind of go back to the guaranteed loan piece of this, there are two types of loans that the Farm Service Agency gives. Direct loans, meaning that they give the money directly to you from the federal government, and the guaranteed loans here, which are those that go through a private bank, but the FSA basically covers a certain percentage of the loss if the borrower defaults on the loan. So if you go to uh, Bank One downtown and Bank One gives you a loan and it's guaranteed by USDA, if you default on that loan, then the bank is going to only have to eat a certain cost of that because USDA usually backs that up to 90% with most of their guaranteed loans. So that is a really good deal. That's another side of FSA loan program. So in order to get a loan from the Farm Service Agency, there's a series of different requirements that you have to meet here. I'm just going to let this slide sit for a second in case you would like to review it you're on your own and you want to pause this recording and really kind of get into do this. But basically, these requirements center around, being able to be responsible for the loan, not having previous criminal convictions, acceptable credit history, certain citizens requirements, not having debt previously forgiven, being unable to obtain sufficient credit elsewhere because FSA is the lender of last resort. Like we talked about, the intent is to graduate you to commercial credit, not be delinquent on any current federal debt other than IRS tax debt, not being ineligible due to some sort of disqualification from federal crop insurance program participation, being able to show that you have the management experience to show that this farm does have a reasonable prospect of profit and being able to repay that loan, and being an owner operator of a family farm after loan closing. Those are broadly what these requirements are. If you want to get more into them, these are things to research and talk about with your lending agent, or to give us a call, or anyone in the Intertribal Agriculture Council's Technical Assistance Network. So switching gears a little bit, I'm going to talk about the Farm Credit System. Now, the Farm Credit System is a network of 72 borrower-owned lending cooperatives structured as a government-structured enterprise. And unlike Farm Service Agency, it is not a federal agency itself, and it operates like a customer-owned private entity with borrowers purchasing stock as part of their loan. It's not a bank, and it does not take deposits. Now, it's established by a federal charter and regulated specifically by the Farm Credit Administration, which is a federal agency of oversight. It provides loans and related financial services to U.S. farmers and ranchers, farmer-owned cooperatives, and other agribusinesses, rural home buyers, and rural infrastructure providers. And they raise capital through selling debt securities, cooperative stock, and retaining borrower profits. So it's one of those that kind of has government oversight, but it functions much like a private lender and a private bank, although it's not a bank in terms of taking deposits. Now, another resource would be Native-focused CDFIs. Now, Native Community Development Fund institutions, or CDFIs, are a great resource in the credit arena, both for financial education and ongoing credit repair and monitoring. They have a partnership with the Credit Builders Alliance, which allows them to report to 2 of the 3 major credit bureaus. Reporting on loans through a CDFI can help you build credit history. Just 6 months of on-time payments can create a solid credit history and a great score. Even small loans can earn you between 15 and 100 points on your score if paid on time for at least 6 months. Also, through their partnership with CBA, CDFIs can help you monitor your credit. And with your permission, they can make soft inquiries on your credit report that won't lower your credit score, but allow you to do some sort of monitoring more than just once a year. So the interesting thing here is that there are CDFIs out there that focus specifically on native agriculture. And those are worth researching because some tribes have them and are starting to set them up. And there is one that is focused on that in Indian country that was originally part of the Intertribal Agriculture Council, but it's on its own now. And those things are worth researching if you're looking to start out or rebuild your credit. Here is a slide with our contact information. Should you have any questions on this webinar, we would be happy to get back to you on them. And if we do not have that information, we will research them for you and connect you with the appropriate specialist if needed. Thank you for taking the time to attend today, and have a great day.